The Federal Reserve Board meets today to decide what to do about interest rates. The prevailing wisdom is that the Fed will do nothing. Every meeting for the past 15 months has ended with an increase in the Fed funds rate, followed by hikes in consumer interest rates on mortgages, car loans, and credit card purchases. Fed officials aren't ready to say the worst is over, so they're framing the latest strategy as a skip instead of a pause. We should know something around 1 o'clock this afternoon.
And financial expert Terry Savage joins us now. Terry, what about that Fed meeting?
Well, this is really interesting, Marcus. As you said, this will be the first time in a long, long time that the Fed has just said, well, we're not going to raise rates today, and that's what the markets are pricing in. But is it over? That's a real question. This morning, we got some good news on producer prices. Yesterday, consumer prices running at 4% year over year, down from 8% year over year a year ago. So the question is, do they really think they have it under control? The jury's out on that. Stock market has been liking this, though. The S&P and the NASDAQ have made highs for the last 12 months. So I just wouldn't jump to the conclusion that it's all over yet, or jump to the conclusion that maybe there won't be a recession. The world is acting like everything's just terrific, but we've got a lot of warning signs of recession on the horizon. So as always, the stock market is entertaining, and you need to be balanced in your approach. That's the best I can say.
Before we get to the viewer questions, I just had a quick question about, the inflation number. The number yesterday was what, 4% that it was up. Of course, like anybody who goes to the grocery store, like prices have just kind of skyrocketed over the last few years. Can we expect those prices to ever come down? Or is this how the economy works? Where they are now is where everything's going to stay, and we hope our wages catch up with that.
Marcus, that's the most interesting part of it. The base becomes what it was. And the concern is how much it's increasing. So the Fed wants the prices to increase only 2% year over year. But you're right. We've already had a big jump. And a lot of people just aren't keeping up. Interestingly enough, there's a forecast now based on yesterday's consumer prices that next year, seniors on Medicare will only get a 2.7% increase in their monthly check. And so obviously there are a lot of people, you're right, falling behind. The base becomes higher. It's the rate of change the Fed watches. And if you're feeling it in your own wallet, yeah, it's absolutely, prices still are higher. And if you haven't figured out a way to earn more or to have a second job, if you're stuck on a fixed income, it's a squeeze.
All right, let's get to some viewer questions. What effect will the debt ceiling agreement have on T-bill rates? Will they continue to be a good investment?
Well, Treasury bills have been a great investment. Banks finally are catching up on their CDs. This morning, 3-month T-bills are yielding about 5.25%, and 6-month bills slightly more. As you know, there's an auction every Monday, and next week you can expect about 5.25%. They still reflect the fact that there's concern about inflation. So it's a safe place. If you go to terrysavage.com, there's an article on the right-hand side under links saying how to buy T-bills. You can start with as little as $100, link it directly to your bank account. Very easy to do. So if your bank isn't paying you enough, you're willing to tie up your money with the government for 3 or 6 months, Treasury bills still a really good alternative.
Yeah, next question here. Person says, I'm having a hard time finding a bank that will provide a HELOC for an investment property so I can remodel my kitchen and build a garage. They do not want to use their own home equity for that. Yeah. What's your advice for them?
So the bank, you're not willing to put your home on the line. The bank, if you can find one to give you a home equity line of credit on an investment property, the bank will absolutely charge you more in interest. You'll have to have at least a 700 credit score. A home equity line of credit will be something you can draw down, but they want to make sure that since you're not putting up anything except the value of the property as collateral, that you have at least an 80% loan value. So you can search for those. You can search at Quicken Loans and Rocket Mortgage, but you can be sure you're going to pay more. And you're wise. Don't put your own home on the line if you're doing an investment property. In case there's a recession, in case the property value falls, in case you can't find a tenant, you don't want to have your own house on the line.
All right, last question. We're wanting to get a home equity loan. This person says to buy a truck and remodel the kitchen. What's the best option?
Well, the best option is to go out and search for a home equity loan or line of credit. But that's not what it's supposed to be used for. We're at the end of a cycle here. We've had a great economic boom since the pandemic. I just want to warn everybody against the use of credit. Do you know the average interest rate on credit cards, and there's $1 trillion in credit card balances outstanding, is now 20.9%. This is a time to be paying down credit in case there is a recession, not building up your outstanding credit.
So here's another question about credit. This person says, my wife and I are in our 70s, have excellent credit, and probably will not have a need to acquire any more credit cards or loans. They have a couple of store credit cards that they've not used for years. And like so many stores, these have gone 100% online. Is it okay to close the cards out? Or closing cards out hurt your credit? Or should you just kind of cut them up and throw them away like they don't exist?
Well, I think, yes, there's a double-sided answer to this. Of course, you want to close out credit cards that you haven't used and don't use, especially if they charge an annual fee. A key factor in your credit score is longevity of credit. So you might want to keep one of the older cards. But if you're not planning to apply for a new mortgage or get a new life insurance policy or apply for a job, your credit score won't matter that much in the immediate future, and it will adjust. So yes, you want to call the store and say, close that account. It's an old one, I don't use it. Then check your credit report to make sure it's closed. Just don't close that Visa or MasterCard that you've had since 1992, because that does demonstrate length of credit history. That's a key factor in your score.
All right, if you have a question for Terry, you can go to terrysavage.com. Thanks for being with us.
Thanks.
All right, time now for Around Town.
Hey, Anna.
Good morning. I'm in the basement of the Charnley